Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. As we are heading into the quieter August period, normally quiet at least, sometimes rather accident-prone, it seems a good moment to try and talk a little bit about long-term context as well as short-term market dynamics, of which obviously there's a great deal going on with President Trump and all the rest of it. But to do that, I am joined in the podcast by an old friend and colleague of mine, Dr. Sandy Nairn, who is the Executive Director of the Global Opportunities Trust, ticker GOT, and also by Alan Bartlett from Goodhart Partners, who are sub-investment managers of the aforementioned Global Opportunities Trust, and a firm that advises and manages money on its own behalf, an independent boutique since 2023. In the interest of full disclosure, I should say up front that I have collaborated with Sandy on a number of projects over the years, starting with his seminal book on technology and market cycles, Engines That Move Markets, published around the time of the Internet bubble, and on several others since then. And I am also a small, modest shareholder in the Trust, Global Opportunities Trust. So I have connections with Sandy, and it's as well that you should know that. But on the other hand, of course, if I can't talk to smart people whom just because I have invested in their companies, this would not be as useful a podcast as I hope it is. Sandy, you've been managing the Global Opportunities Trust now for over 20 years, and they had a bit of a reset recently. Perhaps you could begin by just explaining quickly what the reset has been in terms of the approach and the organization of the trust. It was originally launched in 2003 as a global equity trust with quite a bit of built-in flexibility by your firm, Edinburgh Partners, an independent fund management boutique, which was subsequently acquired by the American fund management group Franklin Templeton, before reverting to its current status as an independently self-managed trust, of which you are the lead nominated manager.
So I'll try and be very brief, but I need to go back to the inception of the trust. So when we set up, one of the things you try and do is give yourself as much flexibility as you think you need to be able to manage the assets in the light of how conditions might unfold. So we had what we thought was a lot of flexibility when the trust was launched. A little bit in private equity, could hold cash. The reality was that that was all fine up until we got to the time of the global financial crisis and then the period of QE thereafter. And there were some bigger events coming along as well, but primarily what we found was what we've termed the everything bubble, that it was very difficult to find assets, and we needed to have a good look at the flexibility of the trust in the light of those changing conditions. So number one, the interest rate suppression period had its intended impact on assets, but it meant that the flexibility the trust had needed to be expanded. So that was number one. Then number two, as we can go on and talk about, we're passing a number of inflection points in markets where things that have been supportive are less so, which again emphasised the need for flexibility. In terms of the actual structure of how the trust is run, it was felt appropriate to move it to a self-managed status. And there was a range of reasons for that. It did help reduce the costs a little bit, but it also coincided with some changes in my career where I was going, but also giving the ability to bring in a lot of resource from elsewhere, which ties in with the earlier points about flexibility. This gave us the ability to access the skills required to run the trust in the light of the way we think the world had evolved.
So just to remind listeners that you were classified as being in the global equity sector, and you had a traditional trust external manager arrangement, and now you sit in the flexible investment sector, so you have that flexibility, and it's a self-managed trust in which I think it's perhaps relevant to mention you do have a significant personal stake of around 15% or so in the trust, which has a market capitalization of around 94 million, I think, as of today. So there's been this change in structure, partly in response to external conditions. And Alan, you've been involved in helping to manage this trust for a shorter period. Can you just explain what it is that Goodhart Partners do and what they bring to this particular party?
Well, we have two sides to the business. The first is we have interest in a small number of boutique investment strategies, fund managers, and the other side of the kind of principal side of the business now is with a global equity boutique or a 9-person research team supporting a range of different strategies that all kind of come under the umbrella of what we call agile investing. And really the way that we've built Goodhart ground up as a global equity boutique is around the principles that Sandy is talking about, the need for flexibility in the way that you manage money going forwards. I think it's sort of easier in some ways to build the team and process from scratch to manage money in an agile way than evolve something else into it, if you see what I mean. And it comes just from a very clear view of the changing drivers of market returns from what has worked over the last 20 or 30 years to what we think is going to drive opportunities going forwards.
Well, let's dig into that a little bit because obviously, in terms of investment trusts, there are multi-asset trusts out there, many of which do a good job, but many of them are very defensively positioned and not looking to make outsized returns, put it mildly, but trying to moderate risk. What is the case for having a flexible investment mandate? Why is that more important now than it was in the past? And in particular, in terms of asset classes that you're actually considering to put into that flexible mix, how do you approach that basic question?
I mean, the strategy is definitely equity oriented. Our core skill set is public equities and stock picking. And so the strategy has a great deal of flexibility in it to invest in other asset classes, but that's the core skill set. And actually, we think public equity markets are the most diverse, most rich source of both return and diversification over the long term. I mean, there are 60 odd thousand listed companies around the world. You can get exposure to anything you can think of in equity markets. But I think what's changed from our perspective is that if you think about the 30 years leading up to COVID, the sort of market forces conspired to create an incredibly benign environment for asset prices. We had a very supportive demographic situation with the industrialization of emerging markets. We were in the narrow-minded but fortunate position to be able to regard environmental damage as not terribly important, and which had the effect of reducing the cost of production, not worrying about the externality cost, if you like. And then post the fall of the Berlin Wall, really the security environment globally was very supportive in a narrow sense, not need to spend as much money on military defense, but actually from a geopolitical perspective, it created the perfect environment for globalization, sort of empowered by technology, specifically the ability to run extended supply chains, logistics, developments, etc. So all of those things conspired to an environment in which we had low inflation, falling interest rates, falling corporate taxes as a function of companies being able to look around the world for where they could operate at the lowest tax rate. And so we had sort of 5 to 6% real returns on equity markets with a few speed bumps. And I mean, they felt worse at the time, tech bubble, financial crisis, etc. But in a historic context, just speed bumps. They weren't really material. The recovery periods were very quick. The absolute drawdowns weren't as bad as people like to think, compared with what has happened over the very long time historically. But now, in simple terms, we think that whilst technology is still massively supportive and frankly necessary to drive productivity gains, the other three of what we call the four forces, the demographics, environment, and security, are really very negative impacts on GDP growth going forwards. And so I think a lot of people, and us included, are very excited about artificial intelligence and where that can go to drive growth. But that needs to be put in the context of other things which are really going to hold back economic growth from a forward-looking basis. And if you think about it in simple terms, if during this incredible 30-year period leading up to COVID, we had less than 3% GDP growth, but we had double that in real equity market returns, we don't think broad equity market returns are likely to be anywhere near as attractive as that on a forward-looking basis. And so in simple terms, we're going to have shorter economic business cycle and market cycles, which means to navigate markets is going to require more flexibility and more ability to focus in on specific investment opportunities that are compelling rather than rely on the rising tide floating all boats, which is essentially what happened over the 30 years to COVID. And I think that explains a lot of what's happened in markets over that period. So the rise of passive investing, the attractiveness of giving up investment flexibility to leverage return in private assets, for example, are also a function of capital market structure and what was driving markets. And we just think that, unfortunately, it's going to be tougher going forwards. And we're not saying that we think that investing over the next 20 years is going to be easy if you're flexible. We're just saying that really you have no choice if you want to deliver attractive returns like we've got in a much lower risk way historically on a prospective basis. We think if you at least reconcile yourself to that reality, then you can focus on trying to extract returns. We're confident, frankly, that you can compound returns like over the last 30 years on a forward-looking basis, but you're just going to have to do it in a slightly different way.
Okay, so let's drill into that a little bit then. So, Sandy, sitting from your point of view, you're the largest investor in this trust, and you're looking at essentially a trust which at the moment has a very significant holding of cash or cash equivalents, a lot of liquidity, and correspondingly a relatively small amount of equities in there. To what extent are you actually looking outside the sort of traditional universe of equities, bonds, and cash for this kind of flexibility and higher returns that you're hoping to make relative to a lower absolute return world?
I suppose the first, not directly answering that question, but just going back to some of the things you said in the introduction about the trust, is that there's a number of vehicles that are managed to keep volatility down, to keep losses potentially down, but they don't tend to change a great deal over time. What we're trying to do is, when we don't find attractively valued securities, we don't own many securities, and when we do find them, we're perfectly happy to go very aggressive, 100% plus invested in the places where we do find opportunity. So in the past number of years, our volatility has been very low, but there's a point in the future when that can change, and we're very happy about that. My holding in it is that's how I personally would want to invest my own assets. That's why they're in the trust. It keeps it very simple for me. I don't need to worry about personal investing because everything comes through the trust in a very tax efficient vehicle, and a vehicle that's also very stable because of the lack of flows in and out, the old traditional strengths of investment trusts. We have the flexibility to look pretty much anywhere. So whether it's public equity, private equity, the question really of where we go depends upon the valuation and our strength of conviction about that valuation. But on top of that, which is important, and I'd like to bring Alan in, is bringing Alan's skill set and others in Goodhart into how we balance risk and reward within a portfolio. Because the flexibility will allow us to do certain things because we can hedge on the other side to get the right risk reward balance. And I think from a personal perspective, for me, what Goodhart brings is that skill set over and on top of what they're bringing with some really talented people that have joined Goodhart to find individual stocks, but to get the balance of risk reward correct to keep it as a proper real return vehicle.
So what's different about the way you analyze risk and reward, in other words, or how you structure portfolios that do actually balance risk and reward in a more efficient and effective way? And how do you measure that outcome?
So traditionally, most investment trusts have a fairly fully invested mandate to begin with, and they can get slightly more defensive, but in the greater scheme of things, not significantly so. So a lot of their returns are highly correlated with the market, and if they're stylistically based with the style that they're associated with, whether quality growth, whatever it is. It's the flexibility that we have, as you noted, was to have a high cash balance, but that allows us to potentially, if we desire, take a bit more risk on some of the stocks because you've got an offset. And then there's other tools that can be utilized to allow you to go into some stocks that you might not otherwise consider if you were not able to offset part of the market related risk. How do you measure that risk? There's all the traditional measures, all of which provide some insight, but incomplete insight. So volatility as a measure is useful, but it's obviously a partial measure since only half the volatility really matters to you, the bit that goes down. And then if you translate that into statistical measures, the relationships between stocks and markets and covariances will tend to shift over time when market conditions change. So what we're really looking at is both the expected return and the degree of confidence we apply to those expected returns to make sure we've got the balance consistent with market conditions and valuations as we see them. So to the extent that we have any degree of accuracy on assessing those market conditions, then the portfolio flexibility allows us to balance the holdings to derive the types of asymmetric returns that we think are appropriate at the time. But I think Alan could put a bit more colour on that for us.
Or maybe not. Market cap weighted indices, they have a gravitational force of a moderate sized sun. I think if you look at the way that equity strategies are typically constructed, even if they run a very concentrated, they tend to end up performing very similarly to markets. And I think if you think about what I was saying before, if you're in an environment where you think the market return is going to be really nice and it's going to drag you up, then stomach the volatility and just sort of hang in there, and the absolute return will be attractive over time. But if, like Sandy and I, you don't think that, then you need another framework to manage a strategy that helps you to structure something that doesn't end up performing like the broad market because you don't think the broad market's return is going to be terribly attractive. And that's the way that the Global Opportunities Trust is managed. And it's trying to take responsibility for the risk side of the equation as well as the return, and ultimately ends up with a very simple portfolio that's focused on half a dozen or so distinct themes that we think perform well together across a range of different market environments. So it's a stock picking strategy that has the flexibility to go anywhere, large, small, mid, any country, any style, any theme, any underlying exposure. But frankly, we couldn't care less what's in any index. And you have to try deliberately and very hard to resist the temptation to sort of benchmark everything you do as an equity investor against the broad market, because it has a habit of making you feel very stupid periodically when things are going up and you're not exposed to them. But the flip side of that is quite obvious. When markets go down, if you have a high correlation to them, you're going to lose a lot of money. And so we're trying to extract an absolute return, a real absolute return over the long term from equity markets by investing in a range of different interesting investment ideas that fit within a small group of themes that we stress test on an ongoing basis every day to try and understand how they would perform in different environments, whether that's the market going up, going down, going sideways, whatever Trump's coming up with on the golf course today or tomorrow, any number of different scenarios, and try and understand what that does to risk return in the portfolio. But at the end of the day, it's 30, 40 stocks, largely pretty simple equity-oriented strategy, but the way that it's managed has meant that it has had very low correlation with equity markets. And I think that's what surprises people, is that you can run an equity-oriented strategy with very little correlation to equity markets. But we think if you're not investing in companies in the same sizes that they are in equity market indices, that's perfectly possible. And if you look at the Global Opportunities Trust portfolio, it looks nothing like any conventional equity strategy or any equity index.
So you can prove anything with numbers, of course, but if you look back at how the trust has actually performed since you started working in this new guise, would you deem yourself to have done well, badly, or on average? Have you fulfilled your mandate? And if so, how do you think the returns look to somebody coming to look at the trust for the first time?
Sandy and I are both pretty cynical guys, as you know, so we'll never be happy. But I think the observation would be that since the strategy changed, the NAVs outperformed broad equity markets with half to a third of the volatility and a negative correlation to equity markets. So if the return was a few percent higher, we'd probably be happier. But I think we've done an okay job of things. Where we've distinguished positively has been in falling markets, 2022 or even earlier this year when markets got a bit volatile in the first quarter. Where we've done less well is when markets have rallied strongly. We've just been too defensively positioned. But again, if you believe what we believe, don't worry too much about not keeping up with really strong rallies, because they will relent. And the objective is to compound real returns over the long term, not to be terrified if you miss out on a few weeks worth of jubilant markets.
I wasn't quite clear from what you were saying earlier, though. What you're saying is that the absolute return from equities in particular, we haven't really talked about bonds yet, they're going to be lower than in the past. And you're hoping to effectively make a real return of somewhere between did you mention 3 and 6%, somewhere between that? 6% is traditionally the real equity return, or roughly like that. What do you think you can realistically achieve?
I think we both think that it is possible to compound returns in the 5 to 6% real over the long term, but to a large extent, you can only generate what the market allows you to generate. So, what we try very hard to do is to not be overly precise in an objective because it creates skewed behaviors. But over the long term, if we haven't generated the long term equity market return in real terms, we're not going to be happy. And we should be able to do that with substantially less risk volatility than markets if we do a good job. And the only way we're going to do that is if we invest in interesting idiosyncratic specialist investment opportunities like small caps in Japan or the defense exposure in the portfolio, where they're able to perform very differently to broad markets.
That 6% was a product of an environment that doesn't exist anymore. So just at a very simple level, if you look at real GDP growth compared to per capita GDP growth, with the past the inflection point in population change, you could see at least a third of that GDP growth disappearing because we don't have the population growth anymore. It's just the structure of demographics makes it incredibly difficult to maintain historic GDP growth. And even if it's not an annual relationship between stock market earnings growth and real GDP growth, there must be a relationship. And so I think if you're going into markets expecting 6% real from equities on average, I don't think that's the right presumption.
And you're saying that on those 4 forces rather than based on the fact that valuations are very high at the moment, which your old mentor, John Templeton, would say that's a factor too.
Absolutely. If you started at fair value, the earnings return and valuation stayed the same, you don't get the 6% real because you're not going to get the earnings growth that you had before, I don't believe, because you're not going to get the GDP growth.
And you might not get even that if valuations are too high at the moment. Is that what you're saying?
Well, then you've got actually either a double or triple whammy, not to be too negative about it, but if long-term real returns drop, then the long-term aggregate valuation should logically drop as well. And we start from above even the historic one. So that's one of the reasons why we're positioned where we are. There's other reasons.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Before we just talk about the themes that you're investing in or the areas where you have some value added to bring in your stock selection, let's just talk about the trust though, because one of the issues obviously from a trust investor's point of view is that you have to think about the discount as well. And the discount in this case has introduced a lot of volatility of its own, if you like, into the share price returns that investors are seeing. I think it's fair to say that the board of this trust and yourself are taking steps to try and do something about the discount, which has got very wide, went out to 30% at one point and has now come in, I think, to around 15, 16%. But if the discount continues to jump around all over the place, that could offset all the good work you're doing by risk management, could it not?
It could, but if we are doing good work on risk management, one would hope the discount continues to come in rather than do the opposite. I mean, as everybody knows, there is a factor in the investment trust marketplace with the aggregation of a number of the buyers, the potential buyers, particularly in the wealth management side, below a certain threshold of size. They understandably are not particularly interested. On the other hand, there is a growing cohort of, I'd call them private professional investors, if you like, who are knowledgeable. And what we've been trying to do with the board's support and with the team that has come in at Goodhart is get the message out there. We felt we needed to get some numbers on the board and then get shoe leather out and go and talk to people and explain what we're doing and why we think it should be important. and you can get a kind of positive reinforcement that comes from that. And the response we've had has actually been very positive when we give the message. Not everybody will necessarily agree with it, and understandably so, but for the people that do agree with it, there are not that many options for them of strategies that are, well, certainly not similar, but not even that similar. So I think one of the reasons the discount has been coming in is partly because there's been some evidence that we're doing what we say we do, but actually more importantly, that we've been out explaining what we do. And that, I think, has attracted some attention and some interest. And we need to keep doing that repeatedly, because I think there is a significant constituency for which this vehicle makes a lot of sense when they hold it along with other potential vehicles. So I would hope that the expanded discount, if the discount goes out, the cohort of people that are interested will see that as an opportunity to purchase, and therefore it doesn't blow out and stay out. It's just a temporary liquidity-driven thing in a short period.
At the moment, the average investment trust discount is 15% or so, roughly, and you're on around a 15% discount. So I guess just taking it in a very, very broad picture, but presumably you would want to bring it in, as you say. Do you actually have a realistic target in mind of what you might do with the discount?
A couple of months ago, if I'd said, I don't see any reason why one day it can't trade around the asset value, there would have been a few arched eyebrows, but I don't see why it can't trade around asset value. If we're able to deliver what we think we can deliver, what we have been delivering, then it's a very cost-effective vehicle with all the things that are being done within it. If you tried to find something similar, you'd end up in the hedge fund world paying a lot more for the skill set that comes through Goodhart. So I think it's entirely possible, but we're some distance away from that. We have to keep demonstrating, we have to keep building the track record, and we have to keep explaining. And if we do all of those things, we haven't talked about it, and there probably isn't time to talk about it just now, but the people who have joined Goodhart are highly renowned investors in their own right. And this is, in addition to running individual funds, this is one of the core vehicles for them to contribute to. So although it's not a huge trust, there's a lot of very experienced, high quality resource being devoted to it. And I think when you combine with what we said about managing the risk reward and the things that get brought to it, I believe it should be a very attractive vehicle. In that case, the discount, I hope, should continue to narrow.
The only other thing I mentioned in terms of structure, obviously investment trusts do have the ability to gear, but there are lots of different ways in which you can use gearing and different ways you can use different kind of instruments as well, not just borrowing. But you don't do any gearing at the moment, I think it's fair to say. How does that fit into your thinking? So if we go back to this happy world where you're seeing wonderful opportunities all over the place, will you be slapping on some gearing as well, or does that really conflict with the underlying approach?
No, it doesn't. It doesn't conflict. When the financial crisis came and markets went down, we did try to gear, but unfortunately, the flip side of the distress in banks was you couldn't actually get any borrowing at any reasonable prices at the point in time when things were cheap. But as you say, there are many different ways to skin a cat. But just as it's an aggressive positioning now in terms of the cash levels, we could be equally aggressive on the other side. If we had a sort of cataclysm and everything was cheap, then absolutely take advantage of it.
So, Alan, from your point of view, how does gearing fit into your thinking?
Kind of as Sandy said, it's just one of the tools that you can use. You can create a geared exposure by buying high beta stocks, for example. So you don't need to borrow money in order to get leverage in order to gear your exposure. If we wanted to structure the portfolio to try and capture 120% of market upside, we don't need to leverage the portfolio explicitly to do that. We just need to buy some stocks that have higher beta. And the way that cash and money market exposure is used at the moment is very much around balancing the overall market exposure that we think is appropriate given the range of investment ideas we've got and where broader market valuations and some of the macro perspective is. So we're cautious at the moment, but not cataclysmically. So if the trust could be positioned much more defensively, but we have an awful lot of flexibility to take on risk. And some of the people that we've brought into Goodhart are very definitely helpful in our ability to do that. So we brought in some really strong small mid-cap stock pickers, a couple of people that have real expertise in technology and artificial intelligence. And the trust doesn't really have exposure to any of that at the moment. We've been careful about how the exposure evolves over time, but we have lots of levers that could pulled in the portfolio to create risk. leverage borrowing just one of them, if you like.
And if we just talk about, therefore, where you are seeing the opportunities at the moment, or where you have seen them, you've talked about new people coming in to look at new areas. Give me an example of a couple of themes that are in the portfolio where you think there's potential for additional returns without excessive risk.
One that we invested in for 4 or 5 years now is the defence sort of theme. Initially, more on the stock level, I think because of ESG issues, the market really didn't want to buy what were cheap industrial cyclicals with quite predictable earnings. And that obviously evolves through Ukraine, and over the last year or so has become very fashionable. So that's been a very successful investment, I think. And this year, that part of the portfolio is up over 30%. And over the last 4 years, has been very attractive. I think one of the key things that we look for, I think Sandy mentioned the word asymmetry before, but that's key to compounding returns, really, is to make more when you make money than you lose when you lose. And so if you can get in front of positive change, but the stock or the industry or the thematic level, that's often the key to creating asymmetric returns. So in simple terms, defense stocks haven't sold off as much as industrial cyclicals normally would in the down periods we've had in the last few years, but they've participated strongly on the way up. So they've compounded very attractively, and we really try and find that and aren't afraid to sort of predict change, if you like. So defense is definitely one. A more recent and less successful overall exposure in Global Opportunities Trust is what we call European value. And in some ways, that's probably a bit of a hedge to some of those more bearish tendencies that Sandy and I have, in that in aggregate, that is a higher beta, higher risk, more cyclical exposure. The company is cheap on a longer term basis, but in aggregate have quite a lot of cyclicality. And so in the environment where Trump's just said that tariffs are off and markets are rocketing, we expect that part of the portfolio to do really well. Conversely, if the market's going down, that part of the portfolio is probably going down more than the market. What we spend a lot of time on is trying to understand the interrelationship between these different groups of stocks so that it can create a more coherent overall exposure to create a smoother return. And that's why the volatility is so much lower than markets, is by luck or judgment getting that right in the last few years. It's important. The European value stocks are all things that we think make money long term. It's just if we have a recession, they're going to go down quite a lot before they go up again. But that has a role in the portfolio. If you just buy 30 stocks that all have the same exposure or the same underlying economic view, you don't have any diversification, and you're at the whims of the market in the short and the longer term.
Perhaps you might also talk about the Japanese reform theme. Now, that's obviously something which investors in investment trusts know well, because there are a couple of trusts out there that are specializing in tackling Japanese companies, if you like, whose corporate governance could be improved, which I guess is mainly what you're talking about. And I think Goodhart Partners has a relationship with asset value investors, which is obviously one of those groups playing that particular idea. Has that run its course now, or do you think there's more to come from that theme?
The stocks are still very cheap, but the nature of the cheapness has changed a bit. If you went a few years back, you could find decent quality growing companies that had incredibly strong balance sheets, far too much cash or Keiretsu cross shareholdings. And whilst there's still, from a global perspective, a lot of that obvious tangible value, more of the value in Japan now is being created by proactive management doing positive things for growth, which is a sort of second stage of that evolution. And I think that's why that theme, if you like, has become fashionable, because it's become more obvious that Japan is changing, that corporate management are changing behaviors, they are focusing on improving return on equity. There are things to be cautious about in Japan from a macro perspective, and as the valuation gap sort of closes, then clearly we don't have to be anywhere. But at the moment, it's still one of the most compelling opportunities that we can see in markets. If you were trying to paint a negative picture, it would be more around the sensitivity that the Japanese public finances have to a fall in equity markets, actually, because everyone knows that the debt to GDP at the government level is very high, but actually it hasn't been costing the Japanese government anything, because they own 10% of the equity market, and the yield on the equity markets pays more than the interest on their debt. But actually, if you want to draw a negative picture, equity market goes down 30%, then they've got the kind of issues that the US has got in terms of funding the national debt. But actually, the irony of that negative, if you like, is that it's one of the things that has pushed the Bank of Japan to push for corporate governance reform, which is what's unlocking a lot of the value. So you always need to look at things from both sides, if you like. And one of the tricky things about being a portfolio manager is you can always draw the negative scenarios, but the short answer is we're very confident in the Japan exposure, but we're not blinkered in the risks that come with any opportunity, hopefully. Japan, you've always got the risk of a big earthquake as well, so that somewhat tempers the exposure that you would want to have to that market over time. Asset value investors are fantastic, and they have a real expertise in unlocking that value through active engagement, which is beyond the resources we have within Goodhart. But we understand Japan well ourselves. Investing through their fund, it gives the trust exposure to something that we just couldn't do ourselves, which we understand and really want exposure to. Until we invested in that AVI's fund, the exposure was direct through larger cap stocks. We had sort of uncharacteristically good timing in selling the larger cap exposures, which had done very well. If you remember, Japan became quite fashionable, and rotating into the smaller cap, much more domestically focused exposure. And from a portfolio perspective for the Opportunities Trust, that's really attractive, because if you look historically, broadly speaking, 50% of the time, if the MSCI World Index goes down, small cap domestic Japan stocks don't. So it has option value, if you like. It's not reliable diversification in that environment, but it has the potential to zig when everything else sags. And we like that kind of profile, something that makes sense on a longer term basis, that should compound 15% per annum over the next 5 years, but has the potential to get there in a very different pathway to other exposures that we've got, and certainly that more generalist global equity managers can achieve, because you can't get exposure to that if all you do is invest in the top 800 stocks in the world by market cap. It's just not possible.
So, two things that you haven't mentioned so far. We haven't mentioned the US equity market, and we haven't mentioned AI, and which obviously there's a connection there. And a lot of people are putting a lot of faith into AI as something that's going to unlock that productivity problem that you identified earlier, Sandy. I know you've been doing a lot of research into AI. You have considerably below benchmark exposure to the US equity market. Is that purely just a function of price and valuations, or is there something else going on there? And what do you think, in that context, the potential for AI to transform the market backcloth is going to be? That's two questions there. Not totally unrelated, though.
So the first one, yes, it's just about price. That's all it ever really should be about. What are you getting for your money? Are you getting the asymmetry you're looking for? And the answer at the moment is generally no. On the AI question, I think the waves are going to start crashing over the shores in the next 3 to 5 years. I think the impact is going to be profound. I don't think it's overhyped at all. That doesn't mean the keynote stocks may not be expensive. One or two of them, I think, almost certainly are. But I don't think we're in the bubble territory where everything just looks like it could never justify its valuation. People talk a lot about AI just now, saying you can't really judge it. The pace of change is so rapid. I actually don't think it is that rapid at the moment. I think rapidity has already happened. It appears rapid to the outside world because this is the commercialization stage. So it's not that the technology, I don't think, is evolving at lightning speed, although it is still moving along. I think it is that it's now being put to use. So it's much more visible to us. It's also something that's constantly being talked about, but the nuts and bolts on the ground don't kind of mirror at the moment the narrative that's taking place. In other words, a lot of the stuff that's happening at the moment on a commercial basis is actually fairly superficial. So it's not going to drive huge productivity gains in the short run, but it will drive productivity gains in the medium and the long term. And it's incredibly profound what is happening. And that means you've really got to understand what it can and can't do and how that will evolve over time. So, as I say, I think in a sense, it's not the TMT bubble again, I don't believe. I think it's an order of magnitude bigger in its importance. And therefore, it's incumbent to understand it for two reasons. One, where the positives come, how it's going to be deployed, where it can help take costs out, new industries that it's going to create. But also, if you think of the old dreaded value traps, I mean, what's a value trap? A value trap typically is a company or a sector where it's been overtaken by events, and what it used to do is gradually fading away. And so that's the opposite side of AI. So you have to understand AI for the positives of productivity growth, new industries, but also the negatives of the places that are going to be in trouble because of it. So It's a big topic. It's fascinating. And I think it's actually understated, not overstated.
In terms of the visible signs of what's going on, there is this massive arms race going on, people investing in AI, particularly incumbent big tech companies who've got an awful lot to lose, like almost their entire business franchise in some cases. So how do you see that playing out? What does history suggest is going to happen to all those companies who are competing to be the dominant players in this new world?
So I think, to give you a kind of 1 minute or 2 minute answer, and it's hard because it's more nuanced than that, but let's just pick OpenAI as a business and ChatGPT. They have the foundation model, which is what gets interrogated. It costs 500 to a billion to go to the next iteration of that. They're going to lose 20, 30 billion plus in the next 5 years, just because of the magnitude of compute cost, but the efficiencies will begin to come into play. It's very hard to make money out of software as a service, and that, getting consumers to pay enough to justify all the cost, I think, is extremely unlikely. Not that they won't get good revenues. I mean, they may get mid-teens billion of revenues this year. So, I mean, that's not insignificant. In my mind, they have to go after two markets. One of them is the advertising market, which is Google's market. And then the other is, if you think of things like computer programmers getting replaced in coding, they probably have to develop their own business in that, rather than just having third parties coming in with APIs to do it. And it's very good at coding. The problem for OpenAI and everybody else is that there's a large number of people dependent upon advertising revenues who are balance sheet rich and cash flow rich and can't afford to lose. So they're all going to put money into it. And that's why you see, it's like the salaries played in the Premier League. They're all going for the same talent because it's that foot race. So that's only beginning to unfold at the moment. So I think things like search, generative AI, and agentic AI, it will all be gradations of the same thing, and they're all going to be fighting over the same pot, is my guess at the moment. I mean, I've still got more work to do, but that to me is the most likely outcome, which means a cost escalation and a fight, because there's not enough revenues to go around for all the players, and there's at least half a dozen meaningful players in it.
So is it too early to pick a winner? In other words, are you looking to back the winner at some stage?
Barring a real technological shift where somebody comes up with a much more efficient set of algorithms that rip the cost out, which was the fear that came from DeepSeek, you would be hard pushed to say that, for example, Google would be a loser, given the technical expertise that resides within the company, given the balance sheet it's got, and that it can't afford to lose. So now, it doesn't mean you necessarily go and buy Google today, because that's a valuation question. OpenAI has a 500 million minimum user base at the moment, and it's reasonably well funded, so they're not going to disappear. There'll be at least one or two Chinese companies doing foundation models and all the things that come off it. The Chinese are very rapid at commercializing. So, being that we're at the commercialization stage, there's going to be a lot of fights between new companies coming that utilize generative and agentic AI. So, where the value actually derives is the big question, which I haven't got a complete answer to yet. So, normally you would anticipate that things like data centers are almost definitionally utilities, but they absorb a lot of capital and there is a shortage, so they would earn more than utilities, but they're capital intensive. So is that enough of a barrier to entry? Probably initially, but not in the long term. Foundation models, I'm not sure how much they continue to capture in value. I think the areas that capture a lot of value are the ones where there's domain expertise, where they really understand the application that the AI is going to. And that's still in the formative stages, but gradually beginning to emerge. So for me, we're going to see interesting businesses emerge at that level of hierarchy, if you like. They're all private at the moment, or the vast majority are. And that goes into a whole different question, which there isn't time to talk about just now, about the inability of private companies to become public because of their valuations. They're in a private equity carousel where they pass from one fund to another, but eventually they will. So I think there will be opportunities. And then the other group of companies are the companies that are going to be able to get more productive and take out significant cost because of what AI can do to streamline their businesses. The financial sector is probably the least efficient sector in the world, and the one where it could have the biggest impact.
Well, unfortunately, not enough time to go into that in more detail. There'll be another opportunity.
Absolutely, just getting started.
Well, we've got to give the listeners a little something to keep for the next time. But it is a fascinating topic, of course, we all know that. But I wanted just to finish, if I could, by just talking a little bit about where we are in terms of the global macro situation and how that might feed it through into what you are doing. Obviously, by which really that's a sort of shorthand for Donald Trump and the US administration, what it's doing with tariffs or not doing with tariffs, and chopping and changing and bullying the Fed and all the rest of it. That's creating lots of volatility, we know. Is there anything that you can do to actually protect against that, or are you also kind of tossing on the waves of Trump's latest whim as a portfolio manager?
So I think you just need to trace through what's actually happening. So the way it's panned out is tariffs are effectively a sales tax, which we all know. So prices will go up, so consumption will drop, so growth will decline a little bit. The Fed will fight reducing interest rates, but in about a year, the new chairman comes in and he'll be a patsy, almost certainly, because we know who's appointing him. And what that does is it removes some of the, I don't know, pillars of certainty is the right term, but it introduces significant new risks about worrying about inflation and stagflation and so forth. So the debt overhang becomes more difficult to sustain because logically people will ask for higher yields to protect themselves. So no matter what happens at the short end, the long end is going to, I think, be demanding a greater nominal return because of the potential inflationary threats. So, none of those things are positive. The other question in tariffs is, what's been announced as deals are obviously not deals at all. I mean, a trade negotiation takes at least 2 to 3 years. It's very precise and it's very detailed. These are kind of like dinner table announcements. So you kind of think that if you were a negotiator, now's not the time to have a fight. You've got a long way from where we are now to actual. I mean, yes, the tariff goes on, but there's a lot of things can happen in the next couple of years. And I suspect some of the people negotiating are in a holding pattern to get through the midterms and see what the political situation in the US is then.
And in terms of how that affects what you're doing, Alan, in terms of portfolio construction and so on, how is this fed through into what you do?
I think sitting on your hands is quite a good idea in this sort of environment because, as I think you were alluding to, the volatility in individual stock names is really high at the moment. We have one position up 10% today off of a really, really small beat. Just market sentiment around shorter term results is pushing stocks around a lot. And the potential to be whipsawed if people react and overreact to things is high. So I think we have a very sort of longer term structural view of markets. I think a lot of what's going on geopolitically is really just confirmation, if you like, to us that what we've been thinking and talking about isn't wrong. And the key really is only to make changes in a portfolio when something has actually changed, rather than just trying to be too cute about market sentiment and things bouncing around a lot. And having a portfolio that is well diversified, sometimes it makes you look a bit cleverer than you are, and sometimes it makes you look a little bit more stupid than you are. And over time, hopefully it compounds into something interesting. But in the last 6 months, there are a lot of opportunities to lose or make a lot of money, but that's kind of coin toss thing. So that's not what we do. So we've got relatively little exposure directly to tariffs, but we have some exposure to companies that do better in a low tariff environment. That's not an accident, if you like. We don't need to be anywhere. So I've got little exposure to the US because it's too expensive. But honestly, volatility is a good thing. Volatility, rotations, uncertainty, they're a good thing for a fundamental stock picker. We just have to wait for the opportunities to come our way. And when they do, then we're not afraid to make significant moves. But turnover's been pretty low in the last year or so, and we haven't overreacted to anything.
What about finally then the dollar? I mean, Trump does seem intent on trying to get the dollar down. Whether or not he succeeds, well, he has done a little bit so far. Obviously, you invest globally rather than just in UK stocks. What's your approach to that, and how do you mitigate that risk?
There's no sort of empirical evidence or analytical evidence that the dollar is either expensive or cheap, in my mind. So what that tends to mean is that it's effectively probably a random walk within reasonable boundaries. So if it gets to one end of the boundary, it may impact some of the decisions we make. But equally, if it goes to the other end, and it's at neither end at the moment. So I don't think there's any particular insight as to what it may do. I mean, it's always interesting to me that commentators say that the dollar slid today, or the dollar had a dramatic rise and it's 0.5%, and the stocks in your portfolio may just have done 2%. It does tend to get overstated a bit. So in my experience, you can base decisions on currencies only when they're at the extreme end of a range. If they're anywhere close to the middle of the range, it's potluck.
So, therefore, to end on hopefully a positive note amongst all this uncertainty, coming back to the Investment Trust, Global Opportunities Trust, trading pretty close to an all-time high and delivering modest single-digit returns over the last 2 or 3 years under this new regime, but positive. The outlook is for more of the same, with the potential kicker of a change in the market environment and a narrowing discount. Would that be how you would sum things up?
I hope so. I mean, I can't wait for the day when I get kind of shouted off the stage for being too positive. I remember 25 years ago, Ian Rushbrook referred to me as a perma bull, and I've been referred to as the exact opposite for the recent period. So yes, this is a try and keep making some money in a holding pattern, waiting for the day when we could try and make a lot of money.
So, on that note, that seems a good note to bring this to an end. So, my thanks to you, Sandy Nairn, the Executive Director of Global Opportunities Trust, and to Alan Bartlett from Goodhart Partners, talking to me on the podcast this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.